Now we'll move on to our next speaker in person of Naomi Nour. Naomi is going to speak to us about responsible deployment of LLM in financial context. And Naomi is an AI engineer with over 5 years in technology and 3 years specialized in artificial intelligence with a background in computer engineering. And she's going to be walking us through the responsible deployment of LLM in financial context. Naomi, over to you. Thank you very much for being here.
Thanks. Hi, everyone. My name is Naomi, and I work at Basis Technologies as a senior LLM engineer. Today, I'll talk about something that's becoming increasingly important in our field, how to deploy large language models responsibly in financial context. We're seeing these AI systems everywhere now, but in finance, we need to be especially careful. Here's what I'll cover today. First, I'll show you where LLMs work really well in finance, but also the serious risks we face. Then I'll walk you through a practical framework that can help us deploy these systems safely. And finally, we'll look at the essential guardrails you need to have in place. So let's start with the exciting part. Where are LLMs actually useful in finance? First, in the customer service. Banks are using chatbots to answer common questions 24/7. Instead of waiting on hold, customers can get answers quickly about their account balance or how to reset their passwords. Second, document analysis. Think about loan applications or contracts. These models can read through hundreds of pages in minutes and pull out the key information that used to take hours to find. Third, risk assessment. LLMs can spot patterns in huge amounts of data, like detecting unusual transaction that might indicate fraud. And fourth, regulatory compliance. Financial organizations have to follow a lot of rules. LLMs can help monitor transactions actually automatically and flag anything that might be against their regulations. And finally, investment search. These models can quickly summarize earning reports, news articles, and market data to help organizations make better decisions. So the potential is huge, but here's where we need to be careful. The first risk is hallucination. This is when the AI just makes things up. Imagine an LLM confidently telling a customer that a wrong interest rate or giving investment advice based on completely false information. That's a loss waiting to happen. The second risk is bias. If we train these models on historical data, they might learn and repeat a past discrimination. For example, if banks historically gave better loans to certain groups, so the AI might continue the pattern, which is both unethical and illegal. And data privacy. These models see sensitive information like customer account numbers, transaction histories, or, for example, personal financial details. If these data leaks or get misused, it is catastrophic. And regulatory violations. In finance, there are strict rules about how you make decisions, how you communicate with clients, or how you handle data. So if an LLM violates these rules, the company faces huge fines. And the final risk is model opacity. This means we can't always explain why the AI made a certain decision. But in finance, if you deny someone a loan, you legally have to tell them why. So we need to balance innovation with responsibility. There is a framework with 5 pillars that work together to make LLM's deployment safe and trustworthy in finance. Think of this as the foundation you must build before deploying any AI system. So let's go through each one. The first one is governance, which is about having the right oversight and decision-making structure. At first, we need to form an AI ethics committee. This should include executives or technical experts, legal advisors, and compliance officers. They're the ones who say yes or no to new AI projects. Second, define your use case approval process. Not every idea is a good idea, so you need a clear process to evaluate whether an AI application is safe to deploy. Third, build a model risk framework. Treat AI models like you treat other risks in your organization. Document what could go wrong and how you will prevent it. And also do regular third-party audits. Sometimes we need fresh eyes from actually outside the company to catch problems we might have missed. And finally, we need to keep an escalation procedure documented. When something goes wrong, everyone needs to know exactly what to do and who to call. Fairness is about making sure AI doesn't discriminate. Test for bias before deployment, and we shouldn't wait until after lunch. We need to check if our model treats different groups of people fairly. And also use diverse representative data. If your training data only includes one customer, includes one type of customer, so your AI won't work well for everyone.
Sorry,
And
we can't see it.
okay, is everything okay?
Yes, I think your screen stopped sharing. I don't know if that's on purpose or maybe it was a glitch. We can't see your screen at the moment.
Yeah, we can see you.
Can you see now?
Yes, it's back online now.
Yes,
Thank you.
back online.
Yeah.
Okay. And we need to monitor for a disparate impact. Even after deployment, keep checking. For example, check are women being denied loans more often, or are older customer getting a worse service? So watch for these kind of patterns. Keep human in the loop. Don't let AI make final decision on big things like, for example, mortgage approval or investment recommendation without human oversight. And run regular fairness audits. Have external experts review your systems to catch problems you might have normalized. Transparency means being open about how your AI works. We need to document data sources. We need to keep records of where our training data came from. And we need to use explainable AI techniques. There are methods that help us understand why an AI made a specific decisions. We need to maintain model cards. These are like nutrition labels, but for AI models. They document what the model does, how it was trained, and how well it performs. Disclose AI use to clients and be honest. Tell your customer if a chatbot is answering a question or if AI help make a decision. And also we need to update stakeholders. Keep everyone informed about how you're using AI, like your board, your regulators, or your customers. Everyone should be informed. And security is about protecting the data and the model itself. We need to encrypt data, both when it's stored and when it's being transmitted. And we need to enforce access controls. Not everyone in the company should be able to access the AI system or the data it uses. We need to limit to those who need it. And we need to have a regular penetration and vulnerability checks. For example, we can hire a security expert to try to break into our system, and we need to find the weakness before actually the hackers do. And maintain AI specific incident response plans. AI system can fail in unique ways. So have a specific plans for AI incidents is very important, not just general IT incidents. And we need to use a secure model deployment pipelines. When we update or deploy a new model, we need to make sure that the process itself is secure. Accountability means knowing who's responsible when things go wrong. We need to assign a clear ownership. For every AI system, someone specific should be responsible. Also, we need to log a model input and output and keep detailed record. If a customer complains or a regulator asks question, we need to be able to show exactly what happened. Also, track performance benchmark and SLAs. We need to set a clear target for how well the AI should perform and monitor whether it's meeting those targets or not. Provide a stakeholder feedback channels and make it easy for user, customers, and employees to report problem or concerns. And finally, hold a regular review cycle. We need to schedule a regular meeting to review how the AI is performing and make improvement. Now let me show the practical guardrails you need to have in place when you actually deploy these systems. Our first confidence threshold for automated decision. The AI should tell you how confident it is in its answer. If it's less than, say, 85% confident, we shouldn't let it make the decision automatically. We need to flag it for a human review. And second, mandatory human review for high impact outputs. Some decisions are just too important to leave to a machine. And third, real-time monitoring dashboard. We need to see what's happening right now. How many requests is the AI handling, or how often is it uncertain? And fourth, circuit breakers for anomalous behavior. This is like an emergency stop button. If the AI starts behaving strangely, maybe it's suddenly rejecting 90% of loan application when it normally reject 20%, the system should automatically shut down or revert to human processing until someone figures out what's wrong. And finally, regular retraining on current data. Because markets change, customer behavior changes, and regulation change. So if our AI is making decision based on data from, for example, 2020, it's probably making bad decision in 2025. So we need to update it regularly with fresh information. So to wrap up, LLMs offer incredible opportunities in finance, but they also bring real risk. The five pillars I've shown you, like governance, fairness, transparency, security, and accountability, give you a practical framework to deploy this system responsibly. And thank you for your attention. I'm happy to take any question you might have.
Oh, thank you very, very much, Naomi. That was really, really insightful. And what I love about this is seeing the full picture. Mark has shown us the technical implementation with specific metrics and dataset control. And Naomi has showed us the governance, transparency, and security framework that makes responsible LLM deployment possible. Mark and Naomi, can you both turn your camera back on so we can go through the questions we have? This is for Naomi. But I don't know. I think Mark should be able to help us with this as well. So it says, how different is measuring bias in LLM versus traditional credit model? So Mark, you have 45 seconds for us. Do you think you can answer that for us, please?
Yeah, I think
Mark.
I think Naomi can add up something. So I will be mostly on the traditional machine learning end. So as I mentioned, DI, EOD, those are the industry standard. And I can assume for LLM, mostly we should check whether there are any hallucinations in LLM, whether there is any bias. For example, if you're asking some question, so LLM should not respond only based on the gender, for example, or age. So I think, so the short answer is no, the approaches are not the same. They are fully different because traditional machine learning model is based on the tabular-like data, and LLM is based on the kind of let's say, text-like context. So those are just different data perspectives.
Okay.
So this is
Yeah.
my short answer. Maybe Naomi can add up.
Naomi, do you also want to add something on that as well? Because I think we have one question for you as well.
So we can go to the next question. Mark answered very perfectly. Yeah.
Oh, okay, thank you. So the next question for you is, what is the biggest risk of deploying LLM in sensitive financial workflows such as customer advisory, compliance, or risk assessment? And what safeguards are essential to prevent hallucination and biased outputs?
The hallucination is the hallucination and harmful advice is the most important challenge we would have when we train on a biased data set. So the second part of the question was what's a safeguard, are essential.
Yeah.
We need to, consider a diverse data set for training our models, and we need to check if our data is balanced, and we need to regularly check the fairness metrics with like error rates or demographic parity or AI 360 fairness metrics. So these are the, checking the diversity of the data set is very important in training or even fine-tuning large language models.
Oh, excellent insights. Excellent insight from the both of you, and thank you, Mark, and thank you, Naomi.